Hi, I'm Chrissy.
And I'm Jess, and this is Financial Progress.
Before we begin, I just want to give a little disclaimer that this is just a conversation between friends. This is not financial advice. Please seek the help of a financial professional before making any financial decisions.
Yes. Hi, everyone. Welcome back to our show.
Today, we're diving into an important financial topic, term life versus whole life insurance. We're going to break down what they are, the pros and cons, and even talk about the benefits of stacking term life policies.
Oh, that sounds very interesting. We'll also touch on the concept of eventually becoming self insured with savings in your 401k, your Roth IRA, and other investments as well.
So let's start with the basics. Term life insurance is exactly what it sounds like. It covers you for a specific period, like 10, 20, or even 30 years. If you pass away during that time, your beneficiaries will receive a payout. But if you outlive the policy, it expires and there's no cash value left.
Correct. Exactly. And then whole life insurance, on the other hand, is designed to last your entire life. It comes with a cash value component, which means part of your premium goes into a savings or investment account within the policy. That sounds great, but it makes whole life insurance significantly more expensive.
Yes. So what's the big difference? It's cost.
hmm
Term life is significantly cheaper than whole life. You can get a high coverage amount for a fraction of the cost of whole life insurance.
Correct. And then whole life insurance premiums can be 5 to 10 times more expensive than term life for the same coverage amount. And while the cash value is a nice feature, the returns are often lower than what you could get by investing elsewhere.
Yes, and this is why many financial experts recommend term life insurance, especially when you're younger and you just need to cover financial responsibilities like a mortgage, student loans, or young kids. And honestly, as long as you're building your wealth, most people don't need life insurance for their entire lives. The whole point of insurance is to cover your dependents while they rely on your income. As you get older and you build wealth and your mortgage is paid off, should, you should need insurance less and less.
Yes, it's true. So I want to give it like a transparency example because sometimes people don't really understand like the minimum payments versus like what actual coverage you get. So I have a term life insurance that I got when I was a stay-at-home mom. So I didn't get something big. I paid $19 a month for $300,000 and I did a 30-year term. So I got that at I think 29, so it'll end at 59. I think it's important to know, so when they say that I guess whole life could be 10 times more expensive. If you calculate that, we'll say like $200, right, for 300,000, but it's for your whole entire life. So just to put some numbers in perspective. Now we're going to talk about stacking term life policies. Instead of getting one big policy, you can layer multiple policies over time. So, for example, you could start with a 30-year policy in your 20s, like I did. And then in 10 years, if you have more financial responsibilities, you can add another 30-year policy to extend your coverage.
Yes, and you can also buy multiple term policies with different expiration dates. For example, a 30-year policy for your whole career, a 20-year policy to cover your mortgage, and a 10-year policy for short-term obligations like younger children.
And then, for example, so instead of buying 1 million policy for 30 years, you can layer three policies. So a $500,000 policy for 10 years while your kids are young and your mortgage is high. You could do a $300,000 policy for 20 years as your expenses decrease. And then a $200,000 policy for 30 years just to cover final expenses and any remaining debts.
Yes, so you're fully covered for 30 years for at least $200,000, and then it
hmm
just decreases over time, which I think is a smart strategy because it prevents you from overpaying for coverage you don't need later in life. And that leads us to the ultimate goal of becoming self-insured. That way, when the first policy expires, you still have coverage in place. This strategy ensures you're only paying for the coverage you need at different life stages.
And as you get closer to retirement, ideally you'll have built up savings in your 401k, your Roth, or other investments. So that's when you start becoming self-insured.
Exactly. And self insurance means you have enough money in savings and investments to cover your financial obligations without needing life insurance. If you paid off your mortgage, your kids are financially independent, and you've built a solid nest egg, you don't need to keep paying for coverage unless you want to.
Yeah, yeah. And like that's something that I think about all the time because I got that 300K while I was a stay-at-home mom, and I'm like, well, now I'm not a stay-at-home mom no more. This is not enough, and I want more. So I am looking into more of stacking life insurance. But at the same time, I'm still building like my Roth and my 401k, my other investments, so that by the time 60 comes, I really don't need all that money because I still have it with my investments, my assets. So
Mhm.
and this is why investing is so important. If you put the difference in cost between a term policy and a whole life policy into retirement accounts, you can grow your wealth more efficiently.
Yes. So, key takeaways: term life insurance is usually the better choice for most people. You can layer policies over time to match your needs, and the goal should be to become self-insured by building up your savings and investments.
Mhm. Please do your own research and do what works best for you in your unique financial situation. If you have any questions or personal experience with life insurance, let us know.
Yes, and thanks for tuning in, and we'll see you next time. Bye.
Bye.